Welcome to the Tools of the Trade podcast with your host, Jeff Boccaccio. Coming up on this episode with Perry Kaufman. If you wanted to start up a brand new hedge fund today, I've got colleagues who have been down this road, so I'm curious. How much money do you think you'd need at the moment, and what approach would you take?
I looked at it recently, and I'm convinced that you can't actually make money unless you have close to $1 billion under management.
People think about the 87 crash and they probably think about the S&P or the Dow. The position that you guys were in, I'm assuming was going to be, it wasn't just the S&P, it was probably a mix of commodities, right?
Everything.
But everything correlates to one when the market's going down and risk is coming off the table.
People don't know that. When you're in a crisis, there is no protection. You know, there's no protection in the market. There's no protection in gold. There's no protection in, fine art or anything else. They all collapse at the same time because people need money to cover their losses, and they sell everything. I don't normally talk about these things, but we had a very large position in oil, and we were losing quite a bit of money. And
before we get started, could I ask a quick favor? If you enjoy the show and want to support us, the simple and free way to do so is to hit the like and subscribe buttons and even share the link with a friend. It really makes a big difference and will enable us to continue to bring these conversations with the greats. Okay, well, hello and welcome, everybody. Thank you so much for joining us today. It's a real privilege and a treat for me. I'm sat here with Perry Kaufman, and I'm feeling a bit spoiled because this is the second time this week I've had the privilege to sit down with Perry in person, live in the flesh. Perry, welcome.
Thank you. Thank you for that introduction. It's unnecessary.
I've got more of an introduction still. But the thing is, Perry made the mistake of telling us that he was coming to London. And then everybody wants to see if they can see Perry. And so I've been a bit greedy and said, hey, would you mind joining me for a conversation here today? So I really appreciate you coming along.
My pleasure.
Let me give the audience a little bit about you, because it's always easier or more interesting sometimes when you're not having to introduce yourself. Oh. So if anybody doesn't know Perry, and you should by now, well, let me tell you how he describes himself, because I love this, and this is kind of how I want, and actually I think will adopt describing myself as an architect for trading systems used by institutions and funds, and actually for yourself, I know as well.
I do trade.
Mm-hmm. Perry is, he's one of the most revered and experienced traders, specifically trend followers, but he's been in the markets for many decades. And so when you start counting on decades, you know you're doing something right, because the guys that don't make it tend to fall off pretty quickly. From my recollection of your background, and you can correct me if I'm wrong on any of this, please, but you started off trading with some of the farmers, right? Hedging some of the agricultures.
Yes, that was actually not the beginning of my trading, actually.
Where was the beginning then? And then I can dive back into my introduction.
The beginning was 1971, perhaps. We formed I used to work in aerospace, and one of my partners convinced me to form a company.
Okay.
And we started doing medical reimbursement, and had I really been smart, I would have stayed with that.
You got the trading bug from there?
Turned out to be a very good field. But somebody came along with an options problem. We were a little small company, and we had a mathematical background, and they went to other places and nobody would do it. So they came to us and we said, yes, we could use the business.
We'll figure it out.
We'll figure it out. And so we did options, and that led to a person who convinced us to trade futures. And he made a deal. He gave us the money and said, okay, you can have 50% of all the money that you make, more than what I make doing trend following. He's going to do trend following.
Okay.
And we did really well, but we didn't do much better than he did.
Okay. So you didn't get much money out of it in
We
the end?
didn't get much money, but we learned a lot.
I bet.
So, and it was actually a very good experience. It got us into trading futures and got us into trend following. And this is where a moving average was the state of the art.
Right. Right.
So
Wow. That's great.
It was. In fact, when I was in aerospace, we used to look at the stock market when we had a little extra time, and we used exponential smoothing.
Yep.
Because that's what we use to predict the trajectory of missiles.
Okay. So slightly more adaptive than just like a simple, standard moving average.
That's debatable.
Okay.
But the point is that's what we use because it was very good for trajectories, and that looked as though that's what the market was. Market was much simpler then.
Yeah.
It didn't have all this noise, didn't have the participation, and I think it's changed. We can discuss that at some point.
Yeah. Yeah. No, I'd love to. Yeah, when you could do things with, one man and a moving average was maybe all you needed to.
Oh, yes, and you
to
had
get advantage.
Donchen with his 5 and 20-day moving average.
Right.
Certainly doesn't work these days.
No, but his channels tend to work still. There's a lot of people that still use them. I think yourself included, right? I remember hearing you that your preferred mechanism for trend following is breakouts.
Except my preferred is breakout, but that's because I'm okay with the risk. The problem with breakouts are that, your risk is normally from the end day high to the end day low, and a lot of people don't like that.
Right.
And but in the long run, it has a better percentage of profitable trades. Moving averages jump in and out a lot.
Yeah.
You get a lot of small losses.
Yeah, a bit more whipsawing.
Yes.
Okay, let me go slightly back on track because I wanted to make sure that I covered a little bit of your background with the audience just in case they're not familiar.
Okay.
So you've corrected me, and you just explained how you got started, which is with, originally a medical company which turned into options and futures. I know you did some work with farmers hedging some of the ags. You worked at Transworld Oil.
Oh, yes.
You were a portfolio manager. I know that you've traded intraday as well, even though you don't do that so much these days, but I want to get into that later. You've lived all over the world.
Yes.
Singapore, Bahamas, Bermuda,
Mm-hmm.
obviously a few places in the States. We were talking about Vermont the other night, nice tucked away up there in the snow.
London. I was here in the 70s.
Right,
late
that's
70s.
right, London as well. I know you work with firms, I think, in other parts of Europe as well. Is that right?
I do.
So you've toured the world
So-
with trading as well, which is fantastic. You humbly said that when I worked in aerospace, which is code for him being a rocket scientist.
Yes. Actually, it was interesting until it wasn't interesting.
Oh, okay.
It was just too much security at the time. We did, after doing navigation for Gemini, we did reconnaissance work in the
Oh.
same group that found the missiles in Cuba.
I see.
And, it was one of these things where you couldn't tell your wife where you were going on the weekends
Right.
because it was all secret.
Wow, that sounds
So-
quite cool, quite cloak and daggerish.
I know it sounds wonderful, but after a while it became, we did all this stuff and then it would be published in one of the aerospace magazines.
Right,
you
right.
know, and we decided maybe the security wasn't quite as good as we expected.
Oh, I can see. Okay. Well, did you find that was a good introduction for the work that you ended up doing? So, I mean, like the mathematics that you were doing for aerospace leading into, say, originally the options and the futures market, and then it's obviously going to be simpler math at the end of the day, and we're trying to keep things as simple as possible. But did it give you sort of a leg up, do you think, in your thinking around how you think about markets?
Well, I think the one that was most influential was this one fellow who was using moving averages that
Yeah.
we had this little, bet going
Yeah.
one way or the other. And after that, I realized that moving averages were very good, but we were down at the 20-day moving average.
It's quite short.
Yes, back in the 70s when the markets were much smoother.
Yeah.
So, and counterintuitive, as markets have gotten more volatile and have more participation, they've gotten noisier.
Yeah.
As a mathematician, I thought the more people that participated and the more diversification, the markets would get smoother.
Right.
But they don't.
Mm.
Everybody has a different agenda, and the markets jump around.
Yeah.
So
Yeah. Yeah. So conversely, like those noisier markets are the ones that are more difficult to trade in a trend following way, at least.
So as time went on, we went from 20 days to 40 days to 60 days, and now the S&P, for example, if you wanted a trend, the best one is 110.
Right. And
So
actually, like I've heard you say recently, the S&P, it's okay for trend following. It's on the short end, it's pretty good for mean reversion.
yes, very good for mean reversion on the short end.
But there are better markets, right, for trend following.
Much better market. Well, the trendiest market are really interest rates.
Yeah.
And up to this past year or so, normally the big funds have probably 60% of their money in interest rate markets, and they're highly correlated. And they've made money year after year after year until the last 2 years.
Right.
With this Fed problem, raising rates and then not knowing whether they're going to lower them or raise them or lower. And so that's why I think if people look at futures performance in the last year or so, they'll see it's gone almost nowhere.
Yeah. Whereas 2020, was it 2023, was actually a really good year for trend followers, I think, right?
I have to.
Okay, I'm trying to think back myself.
Whether it was futures or stocks, going back and forth. We had some very good stock years too.
Right.
So even last year was a good year for stocks, surprisingly. You made money in the tech stocks, and then you made money in biotech, and then it switched around. But in the final analysis, most people came out 20 to 30% ahead last year.
Right.
So
it's a good year.
Not so much this year yet.
Yeah.
But there's plenty of time.
That's true. Yeah, we've been shopping around a little bit so far in 2025. I wonder if we could take a step back. I heard a story about your Transworld days.
Oh.
And because I think you were there over the 1987 problem, the crash. So I wondered if you might tell us a little bit more about that. And I'm specifically interested in, I think I heard that Transworld at the time, this was quite a large account. And so I'm interested in how you dealt with that, how it was managed. Could you tell us a bit more?
This was the 1980s. Transworld and Mark Rich were the two biggest traders at the
Mark Rich
time.
became Glencore, right?
Remember Mark Rich?
Yeah, he lived in Switzerland after
That's
a
because
while.
there were a few tax problems.
Yeah.
And Switzerland looked like the best option.
Right.
But he was our biggest competitor. Transworld is an interesting company owned by one person. Oddly enough, I got a call from them recently and did some work for them.
Oh, excellent.
Recently. They had bought the Philadelphia refinery, everything from Arco east of the Mississippi at the time. So, they were serving. We were feeding the refineries at the same time, so we had a lot of commercial stuff going on.
Okay.
But it was probably the biggest commercial speculative account that at the time. One of the problems with trying to allocate position sizing,
Yeah.
which I advocate now quite a bit, that you should make all of your positions the same risk when you start out.
Mm-hmm.
We traded so much that wasn't really an option. We just traded as much as any market would allow us to trade.
Because you were so big?
We were so big,
Yeah.
yes. You couldn't do position sizing.
Right.
So, although I wonder, going back, had we done that, whether we would have done even better.
Right.
So.
And so you said you said a speculative account. This was not a hedging account for
It was
like physical
speculative.
commodity? Okay.
But, because the company was into so many things, I'm sure they got all sorts of commercial margin
Right.
preference and things. But anyway, we traded, and it was just a lot of fun to do that.
Oh, I bet.
We had tools in the 80s. We had our own time sharing system. And, we could do our own plots way before we have these trading platforms where you can put anything up.
Right.
You know.
What do you mean by time sharing?
We had a main computer in Houston.
Oh, okay.
And we operated off that. So.
Oh, I see. So you had to you had
we
to share time, like
terminals.
CPU time on the machine.
Well, I mean, it time sharing. It gives slices of time
Gotcha.
to everybody, so everybody thinks they're using it
Right.
independently,
I
but
see.
they're really sharing it with somebody.
Yeah.
So it was a wonderful operation run by a wonderful person. So
Wow. So, how big was the team that was managing this speculative account?
well, the team that was doing the speculative stuff was all in Bermuda,
Oh, okay.
and it was maybe 10 people.
And were you out there at the time?
Oh yes, I was in charge of the system
Oh,
stuff.
I see. Okay.
So, and
What-
we had people trading, and it was a dream.
I mean, that sounds like
It
sounds
was
like
a-
paradise. Trading,
it
Bermuda.
was a money was no object type of operation.
Yeah.
The amount of money we were trading and what we were making was nothing compared to salaries and expenses and things like that.
Right.
So it was a delightful time.
Oh, that's fantastic. Now, probably delightful up until the 1987 October
Oh,
19th.
and we didn't do all that badly in it. It was only part of our position. The problem was I was allowed to trade along with the company
For your own account, like a private account?
from my own account. And when the market started to go down, we started to reduce our positions, and each day we'd reduce our position by half. The market would go down twice as much. So we had to get out. We did take a loss on it, obviously, but in my own account, I waited until the company was out of theirs. It's the only proper thing to do.
Okay, so you did the
Company goes first.
You back ran. You did not front run.
I didn't
You-
front run the company. And I look back at it and I'm very pleased with myself to do that because it's an issue of integrity.
Yeah,
So I hold other people to the same standards.
right,
So,
right. No, that's honorable actually, because many people in that circumstance would probably look after themselves and know that there's going to be an extra push
Yeah.
maybe if there's a large position coming through.
Yeah. Yeah, in the final analysis, I lost all my profits for the year, but that's all. I didn't go to a loss, and the company did a bit better. And, and afterwards, things went well afterwards, so,
That's great. Was it a speculative account, but was it, people think about the 87 crash and they probably think about the S&P or the Dow because there were all these big,
Mhm.
it was a pretty significant quick drop, and it was also a pretty quick recovery in many
yes,
markets
by the end
too.
of the year, I think it was profitable.
Even, I think, if I'm not mistaken, was it not days or weeks afterwards when many markets had already recovered?
I can't tell you. I only remember the S&P was profitable by the end of the year,
Gotcha.
or recovered everything.
Yeah. So was the position that you guys were in, I'm assuming was going to be, it wasn't just the S&P, it was probably a mix of commodities, right? But
Everything.
everything correlates to one when the market's
Yes.
going down and risk
Yes.
is coming off the table.
People don't know that. When you're in a crisis, there is no protection. There's no protection in the market. There's no protection in gold. There's no protection in, fine art or anything else. They all collapse at the same time because people need money to cover their losses, and they sell everything.
Right.
So it's, if we get into it, the only way to offset that is to have strategies that are quite different from one another, a mean reversion versus a trend, because one of those will survive.
Yeah.
So,
Well, you know what? I'd love to dive into that now if you're up for it.
Sure.
Because yeah, think about one of the things I wanted to bring that up for, one of the reasons I wanted to bring that up was because it's also thinking about how you handle, that sort of situation. So maybe just before we go into that, the mindset side, right? The psychological side of seeing not only your own personal account but your company account, or maybe vice versa. And I'm sure people are maybe not happy at that point, the boss or the company's money. And so you said you were trimming down those positions, and it would go further and further each day. So you were quite pleased that you were trimming those positions down. Was that part of a risk management plan to trim those positions, or was it just something that you had to adapt to at the time?
That's a really good question. I mean, you're talking about 1987, and I'm not sure we were systematic,
Yeah.
but I'm not sure what system asked us to get out of these, because we didn't trade all at once. We traded in increments. I mean, if you're trading multiple trends, for example, one will get you out. Mm-hmm. And the shorter one will get you out, then the longer one, then the longer one. So it's very likely that's what we were doing, and we'd get one signal to get out one day, and then the next day we'd get another one, and the next one. And so that's probably what happened at the time.
I mean, I would also imagine that it could have been difficult to get out of those positions if everybody's trying
well,
to...
you can always get out if you're willing to take a loss.
Right. Or a slightly bigger loss than you might.
Yes, and we were willing to take a loss, so
yeah.
The whole point was to get out.
Yeah. You seem like such a chilled, calm man. Was that the case if you think back to that time? And it was just like, what can you do? You're following the system? Or were there other external pressures, like maybe people, screaming at you?
No, actually, it was rather normal. I mean, nobody liked what was happening.
Yeah.
But it is...
what you'd expect.
Yes, the head of the company is what I would call a risk seeker.
Right.
So, in fact, there is an interesting story. I don't normally talk about these things, but we had a very large position in oil, and we were losing quite a bit of money. And he called everybody into the office, all the managers into the office, and asked them what they would do. Mm-hmm. And your parents have a lot to do with your approach to risk.
Yes.
It's your...
And your childhood.
Yes.
It's something I speak with Sonal about. You met Sonal earlier. Her whole focus is mindset and trading psychology. And she's found that, a lot of these things are imprinted on us as children.
Oh, absolutely.
Yeah.
And so virtually all of us said we reduced the risk in the position. Mm-hmm. We were losing quite a bit. And he thanked us very much. And he doubled the position.
Yeah.
And he made a tremendous amount of money. The difference between a risk seeker and a risk avoider.
Yeah.
Yeah. The people that seek it and when they're right do very well.
Yeah.
So I still can't change that. I still, in times of risk, I reduce positions.
Yeah.
So...
yeah.
And I'm sure he doesn't.
Well, you know what? Those oil men, they, by nature, many of them were risk takers, I think. And
I guess so.
And many do quite well with it,
But I learned a lot.
Yeah.
It was a wonderful experience. So
it'd be interesting. I bet I wonder if from his point of view, interviewing everybody to find out what would you do, what would you do, if he was looking for everybody to say, yeah, I would reduce risk, and if that was almost making him more certain of he'd already decided
assessing
in a way.
The market.
Yeah, everybody's out. There's nobody left to sell because everybody's doing it.
You're right. That very well could have been the situation.
Wow.
But it worked out, and of course, being in the company, we're quite happy that it worked out.
I bet. Yeah. So how did that experience change how you look at risk and how you build that into systems, or try to accommodate and manage risk in systems going forward from that point?
No, actually, 2008, I think, was probably the biggest one when I realized that
Okay.
markets could continue to go down. And, and you know, 1987 was mostly a stock market event. There may have been other things going on, but as you said, it recovered fairly quickly.
Yeah.
2008 did not recover. It took, what, 5 years, I think, before it
Yeah.
surfaced again. And that's when I started building in different risk controls into the system
Okay.
about things. And even now, uh, my own trend system is getting back into the market today after being out for the last 2 weeks. The risk, what was the AI company?
DeepSeek.
DeepSeek, yes.
Yeah.
We had a pretty big loss a few weeks ago because of that. And we got out of the market. We got out of everything because the risk was too high. And in the last couple of weeks, the risk has gone down considerably, and now we've gotten back in. But that's one of the methods that we put into the system after 2008 was so in the volatility of our portfolio, not the volatility of a single stock,
Right.
but the volatility of the entire portfolio goes above, say, 32, 35%, it's too much. The risk is too high, and you might make a little money, but you do it at tremendous risk. And it's, the market's always there, and you'll have other opportunities to do this. So you just get out and you wait for the risk to go down, and then you go back in.
Gotcha. So that DeepSeek event, which if I recall, the big drop on that one came after a weekend. It was a
Yes.
Monday, and we gapped, and then I think we pushed lower.
Why is it always Monday?
It's always Monday, isn't it? Yeah. People think too much on the weekend, and then everybody piles into something, I guess. So that was a portfolio level trigger.
It was. The rest, yes. It affected the tech stocks, and we may have had maybe 50% tech stocks in it. So we got beaten up on that day.
Yeah.
Not tremendously, but the portfolio volatility went up. And we had discussed this early in the week when we talked, that a single stock in your portfolio does not require that you get out. And if it's doing particularly well, you want to stay with it. But if the entire portfolio goes up, there's a major event going on.
Yeah.
And that's a problem.
Yeah.
And I don't know how far it moves into other investment vehicles or not. But in general, you get out, you're much safer. I think in the last 2 weeks we've been out, the market's really done very little.
Yeah.
So now we're getting back in on lower volatility.
Right. And yeah, maybe the market's a little bit higher than it was when you exited.
Barely.
Yeah.
Yes.
So you've basically just avoided a bit of a potential contaminant that would have driven or could have driven things lower.
Whenever you're out of the market, you're actually reducing your risk.
I've heard you talk about that too. Yeah. So yeah, the risk of holding. See, a lot of people in buy and hold will just say, "Oh yeah, buy and hold forever. You're fine. It'll always be up. It'll always go up in the end." The markets in general, like an S&P or something like that.
Oh
this
yes,
obviously
it does. When the market's on new high, the best thing you could have ever done was buy and hold. But the risk in doing that is gigantic. And not everybody can do it. And they say, that I remember. I listen to the financial news, and they're always saying, "Oh, the market's gone down a long time. Now it's time to buy." Well, where did they get the money to buy? Did they liquidate? They never said that they liquidated anything. What did they do? Hold it down to the bottom, and then somehow they materialize more money to buy?
Right. Buy one more share from somewhere. Yes, I got some more. But yeah, no, if you're 100% in and you're in the buy and hold.
But they never said where to get out, so I don't know where they got all the money from.
Yeah.
So
yeah. So that portfolio level trigger I've heard you talk about before. So if your portfolio volatility, and if I recall, it was standard deviation, 20-day look back.
Yes, I always use 20 days. I found in the long run, I've been quite happy with it.
Yeah.
It's enough to give you enough flexibility.
About a month of trading.
It is a month
right?
of trading, 23 days, 22 days.
Yeah. And it's annualized, right?
Of course. It's the standard deviation of the last 20 days of your returns times the square root of 252, which annualizes it.
Right.
More or less.
Yeah, so that's the that gives you your portfolio volatility, right? And
yes,
it's 30. You used to say 32%, and I think the other day you said you'd upped it a little bit.
I did. I raised it from 32, which was pretty standard. I looked at a lot of portfolios, and 32 seemed to be pretty good. And then I discovered that some of the major traders looked at volatility, implied volatility, the same way. When it got to 32, that was a extreme measure.
Right.
But since there are so many new tech stocks in it, and they tend to be much more volatile, I did another study a year ago, 9 months ago.
Yeah.
And it seemed to be a little higher, so I raised it to 35.
Okay. But DeepSeek nevertheless triggered that 35% one.
50%, yes.
Oh, wow. Okay. Yeah, there you go. Overnight or over weekends.
And it was, yes. I mean, a lot of stocks just went up a bit, but that went up a gigantic amount. They just dragged everything back up.
Yeah.
So
you mentioned, I asked you this the other day, but I think it's worth pointing out just for the audience. We're talking about historical volatility most of the time here. You mentioned implied,
yes.
So like forecast volatility basically from the options market. But I think I remember you saying that you don't really look at that much.
Yeah, I've done a lot of studies with implied volatility because I felt the same way. Implied is more dynamic. It's what the traders are actually thinking at the moment.
Yeah.
It turns out to be very inaccurate.
Yeah.
The traders will jump on implied volatility thinking something's going to happen and nothing happens. And if you use it to position your, the size of your trade, you're jumping all over the place. It's high one day and low the next and back and forth.
The volatility of volatility is quite high.
Yeah, so
right.
It turns out not to be a very useful piece
Okay.
of information.
Yeah.
Although it's nice to trade the short side if it runs up. It comes down very slowly and very steadily.
That's true. That's one thing I wanted to ask you about, actually. Do you have systems that try to take advantage of that, or?
I have systems that trade all sorts of things.
Okay.
But yes, I have one that does trade implied volatility, but very rarely does it go long.
Yeah.
Because it goes up very fast.
It does.
And unless it continues to some, high level, it's much easier when it gets to a certain level to start selling it.
Yeah.
On the first. And it takes a long time to come down in very nice patterns. So you can usually make pretty good money. But most traders know that.
Mm-hmm.
So sometimes you find that the bid and ask of these things don't allow you to do what you think.
Right.
The chart looks brilliant, but if you try to trade it, you get a much worse price.
Right, yeah.
So
the reality of the fill is not necessally what you'd expect when you're looking at just the back test. Do you tend to try to exploit that through futures, or do you use one of the short volatility ETFs maybe?
No, I don't trade it. I don't trade VIX much. I have a system that does it, but my main investment is in trend following.
Yeah.
And I like it. I have multiple trends and multiple entries, and I mean, it's not a standard one moving average trend following.
Yeah.
It can scale into positions, it can scale out of positions, and so that's my main.
Yeah.
And the other one I have that I like the most is kind of a buy the market on a pullback as long as the trend is still up.
Mm-hmm.
And based on that also, I only trade the market on the long side.
Yeah.
I find that if you're using a long-term moving average, the short side, except for 2008 or so, the short side rarely ever makes money.
We're talking about the S&P or like the stock
yes.
markets, yeah.
Yeah. In fact, almost any index market's
Right.
mostly the same. They all go up. But yes, it's what happens is with a long-term moving average, by the time you get a signal to the short side, it's virtually over.
Yeah.
And if you make a little bit, that's something. You can usually make a little bit in futures because of leverage, but not trading outright stocks.
Yeah. You mentioned scaling in and out. Are you doing that with like a different look back range of dates? So like a slightly shorter look back might be the quickest trend following system, and that one gets in first with a piece?
They'd have to be different time frames on moving averages.
That's what I meant
too.
for time
Scale. You get the shorter one scaling in, and then the bigger and bigger.
Right.
In some cases, if people were using multiple moving averages, they should look at the fact that if they're scanning a large number of stocks, it may be better to wait until a stock is in all of the moving averages. It makes it means that the trend is the strongest.
So meaning all of, like, say you've got 3 moving averages that you're following, and you've got 3 different look back periods.
At the time.
So they're all up.
Yes.
All moving averages are sloping up.
If you take the first one, say it's a 20-day moving average, say you've got a 20 and a 60 and a 120 or something like that, the 20 will get in and out a lot.
Yeah.
And you may find that not as desirable as waiting. If you have a large set of stocks, you'll get the Amazon, and you'll get the Nvidia, and you'll get the, Apples and things, and they just keep moving.
Right.
And so you may find they should do their own research in it, but they may find that waiting until all the stocks are in is a better strategy than jumping in and out of each trend.
Okay. Yeah.
Yes, I know we're jumping around.
No, that's perfect. No, I love the jumping around, but I have a few questions in my head from a few minutes ago, and I was like, let me just dial back to one of those. If we just go back for a second to that portfolio level trigger, does that, I presume that you've got a portfolio of systems, and the portfolio level trigger, is that across like multiple systems, which might be trend following and mean reversion? Or are we talking about just like, say, the trend following system, which is made up of maybe 10 stocks or a handful of futures markets?
Each one has their own exit criteria. And just to make it a little bit more complicated, the market can be running up and exceed that volatility level. But you don't want to get rid of it until the market stalls out. In other words, you really want it, if the market's going up really fast and exceeds that and you're making a tremendous amount of money, you don't really want to get out.
Right.
You want to wait until there's some sign, and it can be any sign, whatever you want, a day or two down or a lower volatility. It's like the old days on the floor. The market would run up and you'd hear all the volume on the floor get louder and louder, and then all of a sudden it would stop. That's when you get out. No more activity. All of a sudden something's going wrong.
Right.
And you can do virtually the same thing with the market. If you look at the volume, if you look at the volatility, it's gone up, the volatility is high, and all of a sudden the volatility drops.
Right.
You want out.
So it sounds like you use a bit of discretion with that sort of exit.
That's not discretion. That's fully automated.
Okay.
It was from my wife. My wife was a floor trader.
Of course.
And she had a number of techniques, and that was one of them.
Okay.
Watch the volume.
Okay, so there is actually like a formula that backs that up, or it's not just...
Well, you can do it on volatility. So, the volatility is going up. It's reached 32, 35%.
Yep.
And all of a sudden it starts to drop.
Yeah.
So
So like a 1-day drop would be enough for you to say,
Well, let's not be too specific about it.
Okay,
We don't.
sorry, no
It's
secret
volatility.
sauce. Yeah, okay.
It could be volume too. People can do it different ways. I find that volume and volatility tend to mimic each other in these serious events.
Yes.
In fact, I had a system that essentially looked at getting into drops, sell-offs based on volume. But volume is very erratic, and so I substituted volatility for it.
Okay.
And if I put them on a chart, the volatility and volume look very similar, but volatility is a little easier to deal with.
Gotcha.
So, yes, people can substitute one for the other if they want.
Yeah. We talked about that portfolio of systems. So I know that you've got, we talked about the equities, where you've got a diversified set of equities, but we talked about what's the best number for that. And so 10 is a nice round number that I know that you use. And you've got your own ranking system for how you choose those 10. So you've got an equities trend following system. I believe you've got, what else do you have? I know are there mean reverting systems that you use to complement?
Well, I also have futures too.
Mm-hmm. Also a trend following, but in different,
yes.
A different sort of market.
I had the problem the other day saying this. It's when the market, when the price goes up, but the momentum goes down.
Yeah.
What's the term for that?
Like divergence?
Divergence.
Yeah.
I keep thinking of diversification.
It's close. Yeah.
Yes, divergence. I have a system in both futures and stocks that use divergence because it's interesting. Normally, and in the books, even in my books,
yeah,
you look at divergence as momentum differing from price direction. And the idea is that momentum is a leading indicator of what the price will do. And it's not. It's actually the opposite. What it is, it's telling you that the trend itself is just taking a rest.
A breather.
If I had to, it's almost like a chartist that you have a trend and then you have a triangle, pattern where it goes up and down,
into a consolidation of some sort.
Right. And normally it will break out in the trend direction.
Mm-hmm.
And that's the case with divergence too.
Mm.
You get the momentum goes down. It tells you you're in a pause. And it gives you an opportunity to trade the trend direction by getting in at a better price.
Right.
And then when the trend breaks out again, you get out with a profit. And what you've done is you've captured this uncertainty in a longer-term trend move, where the trend profitability is going sideways, and you've made a little money on it.
Yeah.
So I consider that good diversification for a portfolio.
Yeah. Yeah, well, that makes total sense. It's like a way of you're taking advantage of the underlying trend, which you've already calculated and you already know, and you probably have positions in, or you may have positions.
You have to believe that the trend is the most important part of what the market's going to do. It's going to continue back in that direction after taking a pause.
Yeah. No, that's interesting because classically, and in many of the books, that sort of divergence between price and momentum is a reversal indicator. It's like, ooh, it's stopping here. This is where we're getting.
It's going to turn.
And of course, every now and then, that probably will happen, right?
It will.
Like anything will happen in the market.
Anyone can find an example.
Exactly.
To make it look as though it happens.
Right.
And I have that problem with a lot of things when I read other people's systems and things, and they're always using great examples, and I program them, and
right.
It's not really so good.
Yeah. If you're going to find an example, you tend to try to use one that looks really good.
Oh, yeah,
right?
We always do. But then you have to inspect the system itself and see that it holds up.
Yeah, exactly.
And I tell that with people when I lecture and do anything. I tell them, here are stuff. These are good examples. But, you can't feel good about the system unless you've tested it yourself and you think that it has robustness.
Yeah.
So, how do you trade something based on somebody else's information? You can't. You have to confirm it for yourself.
No, it's that there's that saying, trust but verify.
Yes.
And you may even, I'm not even sure how much you want to trust, but you definitely want to try to do the verify.
Yes, you do want the verify.
Speaking of the systems, that portfolio of systems and diversification, you're a proponent of diversify, but not too much, right? Because you can be overly diversified, and you're not only you're reducing the risk, but you're also reducing the return.
Yes, absolutely.
Does that apply to systems? So, is there an upper limit to a number of trading systems that you could run in parallel that are designed to capture different markets or different pieces of different markets?
That's a good question. Most of the big funds, futures funds and things, seem to have dozens of systems. And I just think that I just don't know how many of these systems actually help their profits. It's just like, let's just go back to stocks a bit and say, how much diversification do you really want? How many stocks do you really want to trade in order to have good diversification? I mean, if you really want it, then you trade the whole market. You might as well trade the S&P.
Right.
And so that's what you get. If you really want to beat the market, you have to trade less, and you have to select what you're going to trade.
Mm-hmm.
And that's a pretty important, concept. Then you have to say, okay, how do I go about doing that? How do I go about picking the best stocks to trade? And I went about it going the opposite way. I said, okay, how can I eliminate the worst? Because if I eliminate, and I did it in futures because I used to trade futures all the time.
Yeah.
If I have a portfolio of stocks and I just take out the worst of the futures, which happen to be silver for the most part, I never had any system that made money in silver.
Right. Okay.
And I took it out. My performance went up and my risk went down.
Okay.
And so I took out the worst. And then I said, okay, let's find the next worst. And in doing this study, I found when you start to look at the quality of returns, in other words, you look at the Sharpe ratio, which is return divided by risk. Mm-hmm. And then people can look at the time to recovery. They can look at, I don't know, how many different factors they want, multi-factor analysis, right, where they put in all these conditions that they want the market to set until they get what they perceive as the perfect upward trend of their portfolio.
Yeah, perfectly smooth.
No drawdowns whatsoever.
Right.
And I did one of those studies in creating a portfolio using genetic algorithms, which is really a great technique. I was able to create a portfolio out of futures markets that had virtually no drawdown.
I bet it looked great.
And we started trading it, and it lost money from day one.
Not even one day of nice up.
Look at I don't know. Maybe it had one day of profits. But it turns out that the market doesn't want to be boxed in with all these statistics.
Yeah.
That you really want to, what we're really looking for are profits. You want the market that produces the biggest profits. Has to have enough volume to trade it, obvious thing. But risk is not an issue. You have to figure out how to control the risk separately.
Okay.
And if you're looking to figure out what to trade, you trade the ones that have the biggest profit, and you believe that persistence will allow it to continue having those profits. And that's how you get to Apple, and that's how you get to Nvidia, because they have risk.
Right.
You know?
Because the ones that are going to have the most profits probably also have the most risk.
Yes, they do.
And so be okay with that and figure out a way to manage risk, which is maybe separate from how you're selecting the markets you want to trade.
Yes, it is different. And part of the risk management was getting out when the volatility gets too high.
Yeah.
But not on a single item, but on the entire portfolio. And then the other one, which we discussed, I don't know if you want to discuss it now, the way I rank the markets.
Yeah, why don't we go through that quickly? Because I thought that was really interesting. As a guy who does, I build and think systems all the time. And, one of the things that I've struggled with a lot in the past has been, well, by what performance metric am I going to judge, basically, these systems? How do I pick which ones are performing the best? Whether that be for which ones do I want to trade, how much capital do I want to allocate to those? And there's so many different ones, and you went through a couple of them, right? Sharp is a common volatility or just risk measured mechanism.
Mm-hmm.
And then people say, oh, we don't like this about, Sharp is penalizing upside volatility. We don't care about that. We like that. We just don't like the downside. So let's just use like Sortino, as we'll only look at one side of that. And so you end up, if I can use your phrase, boxing in, and you're sort of engineering.
That semi-variance is the downside standard deviation without regard to the upside. But the fact is, when you have upside volatility, it implies that you can have downside volatility.
Yeah.
So by ignoring the upside, you're losing out on a major part of the risk control.
Right. So I'm sorry, you were about to describe how you've approached this now, which I thought was really interesting because you're only looking at the profit side, right?
I am looking at the profit side. As I said, I'm trying to get the portfolio to make as much money as possible. I certainly want to beat the S&P.
Yeah.
And this method seems to do it. And as I said, it doesn't address risk. You have to address risk separately. But what I do is I have a candidate list of 400 or 500 stocks. Mm-hmm. And every day I run my system through those stocks. Now, it's very important that you have a system that will make money.
Yeah.
It can be trend following, it can be anything at all. But if you try this just on the returns of the stock itself, it doesn't work.
Yeah.
You need some sort of a filter to get rid of some of the risk and to identify that the stock is doing what you want it to do.
Yeah, so something that will have entries and exits of some sort so that you're not just buying and holding that particular stock.
You need a strategy of some sort.
Right.
And believe me, I've tried it on the returns. It does not work.
Okay.
But a simple trend following system will. And you'll find those stocks that are trending.
Yeah.
And so you run your system through your candidate list and you look at the recent past performance. 2 months, 3 months, 4 months, 6 months. You have to decide yourself.
Okay.
And you rank the stocks by profitability over that period of time. Now, I don't know how many trading platforms allow you to do that. Mm-hmm. I mean, I wrote my own platform. I think there are trading platforms that allow you to apply a strategy to a bunch of stocks.
Yeah, it should be doable.
But then you have to save the performance of that in some sort of a flat file, so then you can sort it and do what you want.
Gotcha.
So that's what I do. And then I sort them to the highest profit or whatever I'm doing here. And
do you assume sort of like a common starting point in like the amount of capital invested, or
Well, I always position every stock every stock with equal risk using volatility. Volatility something.
so like vol targeting, or
It's um, it's the investment divided by the average true range.
oh, okay, I see. So so
So
so you are looking a little bit at the volatility, so
yes,
to decide.
you're trying to get equal risk on things. So you have to divide your investment by the risk in some way, and the
Gotcha.
average true range is is the best measurement of that.
Gotcha. Yeah.
So
Okay.
um,
So yeah, so they're equal risk, and then you run each stock through the system to see how it would
yes,
have performed over the last however many number of months or
yeah,
days it makes sense to you.
yeah. If you don't use equal risk, you find that that the more recent uh, performance, which is at a higher level,
Yeah.
overwhelms all the old stuff.
Oh, I
So
see.
your system really isn't using the full, the full amount of data to
Right.
give you, you know, the type of performance. So anyway, so yes, I do that, and then I look at the more recent performance, so many months, uh, and I pick the top 10 as long as they're making money. There are periods like 2008 where none of the systems were making money. And so you wouldn't have any positions whatsoever.
Right.
So you want positions that are in fact making money, but it doesn't matter how much.
Okay.
You know,
Even a small amount, but over that
yeah.
whatever that period was,
I mean,
2 months.
a trader can say, no, I don't want anything that's not making 10%.
Right.
That's not what I do, but they're perfectly willing to say, okay, I'll only use the last 1 month, and I don't want I don't want performance that's, making less than a certain amount.
Yeah.
Those are all legitimate ways of using the same
Sure.
technique. So, and as I said, I run this every single day,
Right.
and I re-rank them every day, and the ones that fall out of the top 10 I get rid of, and I put the new ones back in.
I see.
So
I wonder if we could go into taking the systems, or the output of that ranking system, and then implementing it. It sounds like it's going to be generating quite a few different trades. In your experience, for the way that you run it, how frequently are you switching in and out of trades? Are you active? Like, are there
yeah,
orders every day or fills every day?
yeah, that's a very good question. Well, the market's running in one direction, you get nothing actually,
Right.
because all the stocks remain relatively the same in their positioning. Um, the ones at the bottom, the ones in place 10,
Yeah.
tend to jump in and out.
Okay.
And so you give it a little extra latitude, and you say, okay, I won't get rid of them until they go to position 13 or 14 or something.
Okay.
Otherwise, you are jumping in and out.
Right.
But this is the way the system controls risk, one of the really big ways, because if it was just a long-term trend following system, I might hold a trade for 40 days, 45 days. But when you're looking at all of the markets and you're looking for the ones that are doing the best, you could find that a system that's doing perfectly well is not doing as well as a new tech system that's all of a sudden doing brilliantly.
Right.
And so you get rid of a stock from the top 10 that's still making money,
Yeah.
and substitute it with one that's doing even better.
Right.
And so you're not waiting in the typical trend system for this give back of 20 or 30% to get out,
Yeah.
which I think is tremendous. So instead of a 40 or 50 day holding period, you're down to, I think, 18 days
Okay.
is the last time I saw some holding a
Average of 18?
yes. So it's like 3 weeks I'm
Right.
holding a trade. And I have 10 stocks in 3 weeks, so I'm getting out of a couple every day
Right.
or every couple of days. It's not all that active.
Yeah. But you know what? That's a bit more frequent than I thought it might have been.
Okay.
So no, that's good. So if from a daily routine point of view for yourself, the system is totally mechanical, systematic, but
100.
the execution of the system requires you as the human, as I understand it, or at least that's the way that you choose to run it.
It's all the stuff on stocks are on the open,
Okay.
and all the all the executions for futures are on the close
Yeah.
because the market opens right after it closes.
Right.
I don't have my data downloaded and I can't run the system.
So just go. Yeah.
So we do it on the close. It's not actually as good as executing what used to be the open. So I recommend people look for where the volume opens where the volume increases on the open. And if they can, they should trade the signal
At that point.
at the,
Yeah.
yes, what used to be essentially the old open.
Like the pit open.
Yeah.
Yeah.
20 minutes before the Fed announces its stuff for
Right.
the interest rates and all that stuff.
Right.
And it turns out that that's a better place because if the market's going to do something trending during the day, you want to be in ahead of it.
Gotcha.
The system still makes money on the close, but I think it's better not to.
Yeah.
Now, from my own point of view, for stocks, you can trade on the open, and because I'm here with you today, I placed all my orders on the open today.
Oh, okay. Yeah.
But generally, I like to watch the market ahead of the open.
Yeah.
And if I look at the news and I see what's happening in the news and whatever's happened, I sometimes will get in a half an hour ahead of the open.
Okay.
Or if I don't like the stock because it's produced a couple of losing trades, I might wait till after the open to get in. But I'm always in.
Okay.
It's the trader in you. You want to beat the system.
Yeah.
And I was saying the other day, I'm not sure. I think I do. I keep doing the same thing because I think I beat the system. But in all honesty, I don't know.
Yeah. Yeah.
So,
Sometimes you don't have to look all that closely.
yes, but I feel better about it.
Yeah. It's you must be familiar with Van Tharp.
I am.
Okay.
I don't know him personally.
Oh, that's okay. I drank the Van Tharp Kool-Aid, to coin a phrase of an old colleague of ours, quite a long time ago. And so I think about a lot of things with his lens and also Ken Long, but so specifically risk, but he had a concept. So one, we were talking about performance metrics a minute ago. He has one he calls SQN, and it's pretty close to the statistical t-test. And he calls it SQN. It means system quality number. It's a way of judging how well a time series, it could be a system, it could be a stock, any market really is performing. And so that's a label for how well the system is performing. And then he's got an idea for the trader quality number, a TQN. And so that is you as a trader, if you're running a system, and
Yes.
whether it's totally mechanical, or you're adding a little bit of discretionary flair on top, how well are you doing compared to the system? So is your TQN higher than your SQN? And
Yes. Actually, we should keep track of whether we're doing better or worse, but it's not that important. I'm in the system, but I have a feeling for certain stocks that pop into the 10th slot or the 9th slot that they're a little erratic, and they might
Yeah.
pop out the next day.
Yeah.
And so I'm a bit reluctant to jump on top of them.
Yeah. I mean, because it could be an earnings day or something that just pops it one way or the other.
Yes, it could be.
Yeah. Okay. I guess one thing that was interesting to me is that despite the system being totally mechanical, you have and always have, I believe, executed it manually, as opposed to having the system handle all of the orders for you automatically.
Yeah, well, we went through that some time ago. There are tools that will take an automatic system and automatic generate an order.
Yeah.
But there are so many uncertainties with that. You know, you're sleeping at night and you get an order and somehow it adds a 0 to the end of the order.
Yeah.
You know, it's not something you want to face in the morning.
No.
So
it can happen.
yes.
And
So we do the executions manually.
And has that always been the case? Like even from your hedge fund days, portfolio manager, everything was always executed manually, whether by you or someone in the team?
Well, you know, sometimes you want, you know, an average entry. You want to put your order in a little at a time here and there. We're trading gigantic amounts at Transworld. You couldn't put the entire order in, you know, 10,000 Swiss francs, you know, what are you going to do with that?
Right. Yeah, so you need to work it in some way or get a broker or somebody to do it for you.
And they didn't have, you know, orders that averaged in over the day.
Right. Yeah.
You know, based on volume, based on time, based on things. So
yeah. Now there are clever entry algorithms that will work that order in a little bit for you, or you can hand it to somebody else to do.
Yes, we tried our own entry algorithms with it, and we were reasonably successful, but just, you know, averaging in by volume is probably the easiest thing.
Okay. If we could maybe just talk hypotheticals for a moment, and I'm trying to make something useful for the audience who might be listening in.
Yes, hypotheticals. I made $2 million this week.
Exactly. Yeah, sounds fantastic. If you were to, you've worked in funds before. I think was it Graham Capital?
Graham Capital, yeah.
And that was a systematic fund that you were running at the time, or portfolio?
They had discretionary and systematic, but we were in the systematic area. Gotcha.
Because a colleague of mine recently suggested I speak to Graham with regards to their discretionary traders, or that myself or Sunil specifically speak to them. So I'm aware that they do both, but they originally started with systematic, I believe, right? But so if you were starting a fund today, that's the hypothetical part. And how would you approach that? Like if you wanted to start up a brand new hedge fund today, I've got colleagues who have been down this road, so I'm curious. How much money do you think you'd need at the moment? Do you have any ideas? And what approach would you take? Would it be exactly what you're doing today, or would you adapt it for, say, a larger amount of capital?
No, it is. I do have multiple systems, but not too many. And each one has to target a different part of the market.
Yeah.
I do feel that the more systems, there is a point of no return here where you have too many systems and they can't all be working correctly at the same time. But there are, you know, there are areas that are quite different. Like FX, we did a big program in FX carry, quite different.
Yeah.
So, but no, I do the same thing. The problem is these days, the legal requirements are quite different.
Yeah.
It used to be you could work out of your garage. Now you need a compliance officer. Mm-hmm. You need attorneys. You know, you need a lot of stuff. I looked at it recently, and I'm convinced that you can't actually make money unless you have close to $1 billion under management.
Okay.
Because the fees, when I started in the 1970s, we made 15% of the profits and 0.5% a month in fees.
A month?
A month.
Wow.
6%.
That's a good admin fee. Yeah.
Yes. And we made a lot of money in futures and nobody cared.
Because you're making a lot of money.
Because we're making a lot of, you can't do that. Now the fee is 25 basis points, 50 basis points.
Yeah.
If you look at how much it is to man a staff of people with things, you'll find that it's $100 million is not enough.
Yeah, well, that was going to be my starting point. Do you think you could do it at 100 million? And
I don't know.
Not so much these days.
Not if you have a compliance officer and this and that and traders and.
There are ways you can outsource some of those roles, but still, you know, that's going to be a cost still.
Yes, you can probably outsource them, but I don't know.
Yeah.
When I looked at it, I said, would I really make enough money with 100 million under management? And my answer was no.
Yeah.
So it's
And
sad.
well, and then you've got to go and raise the 100 million.
Yes.
Um,
And to do that, you need 3 years of performance.
right.
Sometimes you can convince somebody that with your experience, a year may be enough. But, 3 years, and if you do something wrong in those 3 years, you have one risky period, you're out of business.
Right.
It's not easy.
Yeah. Yeah. Before you even start, and that's the experience that I've seen from colleagues who have sort of been down that road too.
Yeah, I actually tried to get registered as a investment advisor because we had, we were thinking of doing it for stock clients.
Yeah.
And we had, whatever it was, I don't know, half a million dollars or a million. No, it was $50 million or something like that. And I called up New York State, whatever it was, and they said, "You've got to be kidding. We don't care about you."
Right.
They don't want people registering unless they have a lot of money.
So are you saying that you could actually perform the role without registering?
I think you can have 20 clients,
Yeah.
I think is the rule of whatever sort,
Gotcha.
and not register.
Okay.
Although I think at some point you always used to keep registering in the back of your mind.
Yeah. Yeah.
So
Well, I mean, the last thing you want to do is run foul of any regulator or problem there.
yes,
But then at the same time, you're balancing the cost, the bureaucracy, all of the work that takes you away from doing the actual
yes.
skill, the act, the trading itself,
Yes.
or the research, right?
And if you're like me with relatively small operation, that would really divest your time,
Yeah.
or reduce your time.
Yeah.
How
about if you, let's say you've got a retirement portfolio of, say, I don't know, let's call it 2 million, so that it's sort of on maybe the lower end of what a lot of people might aim for.
Mm-hmm.
And so you're retired currently, or you just retired, and you've got say 2 million in savings in those retirement portfolios, or whatever it is you've got it in. Would you do anything differently if that were you in this circumstance to what you're doing today?
You're talking about me personally.
I am.
No, I'm used to risk.
That's the.
I would not recommend it for other people.
Yeah.
But I'm willing to take a 20% loss.
Yeah.
Which happens. 20% is not unthinkable.
Certainly not.
In the market.
And I think as you approach maybe retirement years, you don't really want to have that 20% loss, right?
No, you don't. But also, I don't want a 2% return in bonds.
Right.
But with 5%, the extra money we've had, we put into treasuries, and we've kept our trading account much the same.
Right.
But as treasuries go down, we'll probably put it back in the market.
Yeah.
But it's the psychology. It's like the person that ran the company that doubled the position.
Right.
When we all voted to reduce it.
Yes.
It's your mentality.
Yeah, it is. And, I think, and so many people, myself included, sure, 20%, no problem. I could easily stomach 20% until you're in that sort of situation.
There, yes.
And then it's a very different thing. And it can cause you to, make changes at that point.
Rethink it.
Right. Usually at the worst possible time, right when things are just about to maybe recover.
Yeah, it is what happens, yes. Anyway, that's why I recommend when people start trading, I recommend that they use a small amount of money but actually trade, not just paper trade.
Yeah.
They don't know what a loss is until they put their money in and they get their loss, and then they have to rethink what they're doing.
Yeah.
That paper trading is not the same as actually losing money.
No, when you can just reset the paper trading account back to whatever number you want it to be.
Yes.
It's not the same as...
We had an old story of our daughter who was a runner on the floor.
Oh, it's all in the family then, is it?
Yes, it was a while ago.
You and your wife and your daughter as well?
She's older now.
Okay.
But she was a runner on the floor. And one of the traders said, here's, I can make some money for you.
Yeah.
You know, and how would you like to participate in this trade? And she said, great, because he made a lot of money. And whatever it was she gave him, he went in and he bought and sold and she made like $500. And she was so excited, you know, and the next day she did the same thing and he made like $250. Fabulous stuff.
This is great.
and the next day he went in and lost 1,000.
Mm-hmm.
She was so sick she couldn't go to work for a week.
Oh, bless. Yeah.
That's what trading is all about.
No, and I bet he didn't describe what the risk might be, you know, when...
Oh, she must have. She sort of must have known.
She ignored it a little bit, yeah.
You know, his attitude towards it, $1,000. You know, I've made and lost money before. It's nothing.
Yeah.
But to her, it was a lot.
Oh, yeah, yeah.
So, and that's what new traders need to know.
Yeah.
So,
can I ask you what, just before we wrap it up, the last topic for today, I really wanted to ask you about intraday trading. Now, I know that you don't do it currently. I know that you've done it in the past.
Oh, yes.
And I was curious, I guess, as to, like, we do a lot of short-term trading, and we do trade intraday as well as long-term. We kind of run the whole spread. But I, maybe a bit like your wife, tend to sort of like gravitate towards some of the shorter-term stuff and the intraday stuff. If you were going to approach that today, do you have any ideas on how you would, what sort of strategies you would look to, or what sort of approach you would take?
I do.
Is it anything you're willing to share? And it's okay if you
Yeah, no, I have some systems that I've worked on, and I don't trade them. I've tried offering them to my wife, but she's her own trader. She trades intraday.
She has her way. That's okay.
I would wait for, first you need to find the more volatile markets, because anything less doesn't cover the costs. So you're already starting with you know, some degree of risk. I would wait for a market to gap up and wait for like volume to settle, and then I'd be selling it.
Okay.
And
are we talking about like a futures market or
a futures market, because you want the leverage.
Okay. Just that we don't get gaps all that often on futures.
Or wherever it opens.
Okay.
You want to let it run up.
I see.
And, you know, even if it opens quiet because it opens half an hour after, you wait till the economic reports come out.
Yes.
And then the market jumps up,
Okay,
and
I'm
then
with you.
quiet, and then you want to sell it. And because that's where the opportunity is. You need the market to do something in order to have enough of the day's range to make a good profit. You do not want to buy the open where it closed yesterday.
Yeah.
Because you've now reduced the potential profit to half the day's range.
Okay.
So, and you can do that. There are a lot of days in which the market will run up and you'll sell it and it'll come back to the close or below, and you can buy it back and even go long. And, you know, the market will fluctuate. Linda Raschke says that the market is mean reverting in the morning and trending in the afternoon. And
Yes.
I believe that's true.
Yeah.
So most of the money you'll make for intraday is going to be in the morning. And then if you can find a place to settle down in the afternoon, you can do that. But otherwise, you just trade it in the morning when all these reports are coming out and the market's flopping around, not knowing what to do.
Right. So it sounds like you're saying essentially fade the gap that is the gap that can occur from those economic news announcements that
Yes.
come at, say,
Yes,
8:30 in the morning Eastern, and then at 9:30 all of a sudden we're opening higher, we run up a little bit, but now there's an opportunity to bring it back again.
Yes.
Yeah. Okay.
Yeah, because the market, it does what it's going to do after the reports, and then it's done.
Yeah. Yeah.
And it will usually settle back, and I don't know how far it'll settle back, but there's going to be an opportunity for a profit.
No, I've certainly witnessed that, and that's comforting because I feel like I'm on the right path and I'm doing some of the right things.
Yes, and in some cases you can trade in and out for the day if it's volatile.
Yeah.
It can be good, but generally one trade is usually enough.
Yeah.
So
great. Look, I want to be respectful of your time. So let's wrap it there for today. I want to thank you so much for coming along and chatting to me again. I could sit here all day, so I really have to stop myself.
Well, thank you. I appreciate that. It's nice.
And just, thank you for coming over. I hope you've enjoyed London, and you've got a few more days here still.
Oh, yes.
So,
we'll have a good time.
Yeah, so please enjoy the rest of your time. Just a final thank you for coming along, Perry Kaufman, everybody. Real pleasure for me.
Thank you very much, Jeff.